basic screen of a PowerOptions trial account. For those of you just getting started, you want to make sure that you take advantage of the 4 steps that are listed here. Access the quick start guide, view several of our flash tutorials we have available to help you get familiar with the tools, join us for our free webinars at any time during the week, and also schedule that free coaching session. All right. Now our first couple of questions come in from Scott, and Scott says that he currently is in a married put position, probably radioactive trade on CVRR. The put expires in September. The stock's going sideways, and he has a very small loss. Are there any other income methods that you can consider? Well, let's go back in time. I'm going to look back a little bit historically, Scott. I don't know your prices, but that's okay. We're going to showcase using some of the historical tools here to go back and see what we could find on CVVR. Or is it C? Yeah, okay, so let's see what that is. Oops. Would help if I wrote it correctly, wouldn't it? There we go. First, let me go to the chain here. All right, so it's at 1093. Let's go into the married put tool, and I'm going to click on backtest. Now I can have 2 tools available here, searching by my criteria historically or searching by symbol. I'll try to search by symbol first. Let's go back maybe a month or 2. Let's go back to April 1st, and we're going to look up September expiration. I'm going to look at more results to start with, and we'll do CVRR. Okay, the stock we saw was currently at around $11. All right, so there's no positions there. Let's see if we can get all results opened up. There we go. Okay, so the stock's dropped maybe down about 50 cents since April 1st. And what I'm going to want to do here is I'm going to enter this into why didn't it select September? Let's do September. It's not going to show up, though. Okay, why didn't that show up? That's interesting. Probably because there's no open interest. No problem. Let's go back to the chain. I'll do it that way. All right, so we'll go back to the chain. My apologies, folks. I'm going to go back historically again to April 1st. Let's just take a look at the general put chain. So just want to make sure I'm looking at puts only for the time being. And I want to see the September expiration. All right. So with the stock trading at around 11.56 on April 1st, I may have bought the 12.50 put with a bid of 180, ask of 235 there, so about 55-cent bid-ask spread. So let's go ahead and put this at $2.05 at an ask price. So we've got 11.56 and $2.05 ask for our 12.50 put. Let's see how that looks out. We're going to put it in the portfolio. Actually, yeah, let's put it in the portfolio tool. And as I have created the portfolio here, I'm going to select my strategy. This is a married put. I'll just plug in our stock symbol, CVRR. 100 shares to keep things simple. Change our trade date to April 1st. Keep the math simple, 0 commissions. Let's put in a price of $11.55. And at the same time, we would have bought the September 12.50 put at a cost of $2.05. Let's make it $2.10. All right, so if I'm tracking this position in the portfolio, okay, and Scott, yeah, there's your question. Let's see here. Mike, okay, I'm sorry, just scrolling through the questions there. Let me get through this. We've got a lot of questions coming in. That's great. We'll get to them all. Just wanted to see where we were. Okay. So as I'm tracking a position in the portfolio, as the stock moves up and down, we're down about 62 cents on the stock from our entry price, so we've got about a 5% loss. The put has actually only gained about 20 cents to the bid price, but we saw the ask price was at 260, so we might get 245, a gain of about 35 cents. Delta of about 0.5 when we open the position, so that makes sense there. But as I'm tracking any position in the portfolio, I want to go to Position Actions and Position Analysis. All right, now this is going to give us a breakdown of our current position. Based on the numbers I used, our married put still has infinite upside. We've got a limited risk of only 8.4% on the position. Now, as I scroll down, I see the current liquidation value. I have a loss of about $72, or 5.3%. Of course, my maximum loss, if I hold it all the way to September and make no adjustments, would be that full loss of 8.4%, assuming the stock stays at 1093. So we're a little bit more than 50% loss based on the numbers that I used. As I mentioned, if I closed the put now at midpoint, we'd reduce this by about 15 cents, so it wouldn't be that high. Now it shows that no rollout opportunities are available based on the strikes that we see and what we would commonly do in the radioactive trade. Okay, and I'm going to discuss that in just a second. There's a question that came in from Jerry, and I'll address that in just a moment. Now, so I don't see any rollout opportunities, so I'm going to go ahead and go to the profit and loss chart. And this again takes us to what's called the custom spread tool, the profit and loss chart, and we see our same position. But now I can do some manual adjustments. Before I make any adjustment on a position, whether this is a married put, whether it's a covered call, whether it's a bull put credit spread, you know your stock, Scott, I do not. So the first thing I'm going to do is click on the More Information button here, and I'm going to go to Stock Research. And we see that the next earnings, we've already had earnings, so the next earnings are out to 7/28. I don't have any dividend payment coming up. Looks like I paid a one-time dividend of 101 on 11/5, but it doesn't pay a regular dividend. Okay, so that's some of the two things I want to know before I make any adjustment. Why? Well, I don't want to put myself in a position that maybe has a capped gain or increases the risk if I have earnings coming up in the next 2 to 3 weeks. Why take that chance? I don't want to cap the gain by selling a call if earnings are coming up. And I wouldn't maybe sell the 10 or the 10.50 call if it was available, or maybe even the 11 call at this time if it was available, looking at May or June, if I have an ex-dividend date coming up. So I don't want to probably take the risk of early assignment. Now with the stock at 10.93, the first choice one might consider is rolling down the put to lower the cost basis on the position. Well, I don't necessarily want to roll down the 10 put. That's drastically going to increase my risk. Sure, I might get $2.30 back for this position using the midpoint, and I'd only pay maybe $1.95 for the 10 put. Okay, but in that situation, I'm getting a credit. I'm lowering my cost basis by roughly $1.30, but I'm increasing the potential loss, the guaranteed exit, by 2.5 points. So I'm going to jump my risk up by $1.20 here, so it almost double to probably 16%. Might not be the best choice to do income method number 9. Another opportunity you might consider is right now only the June series is available for this position. If you're looking, Scott, for maybe holding the position through July earnings to see if it comes back up, or if your speculation is the stock's going to recover, what you may want to consider doing is rolling the put in time. Okay, so I could sell this 12.50 put here, of course, for about $2.30, we said, if we got the midpoint, and I could maybe buy the June. Let me explain this here. We're going to go with the June. That's probably going to be about $1.55 to $2, so we're looking at maybe a $1.80 price. So we're only going to gain 50 cents of credit on this position, which means we're going to lower our risk since we're keeping the same strike price, but we're shortening the time frame. Now in this situation, we'd lower the risk down to 65 cents or 4.9%, but we only have a put now out to June expiration. So you've canceled some of the risk. You've lowered it by not quite half, and you've kept the insurance in place. But remember, we saw that the earnings were coming out in July, so this June put wouldn't help us at that time frame. Okay, we want to go further than July, and right now there's nothing available in this situation. We have May, we have June, we have September. So I can't give any direct trading advice, but rolling the put in would help you reduce the risk. I may consider now, naturally I can't sell a 12.5 call, it's only about 10 cents premium. And in June, I'm not going to get 65 cents for that 12.5 call, so I don't want to sell that right now either. If the stock moves back up, I may try to sell that. That would just create a conversion trade, a straight loss profit and loss chart. All right, so what I might consider, if this is an option to me that looks good, but I want to be further out than July, is I may stand pat on this position through May expiration in the next 14 days. Why? Because the Monday following May expiration, we are likely to see a July and potentially an August expiration. I'd be looking for the August perhaps. I could roll in from the September to the August if I can get maybe 40, 50 cents of premium to cut that risk down. Okay? And then I can still look to maybe make other adjustments in June or July before the August expiration, and I'd cut my risk down by almost half with still being able to hold through July through the earnings. If you feel, Scott, that this stock is not going to recover, It's going to stay in this trading range. You don't want to tie up your capital, perhaps, through that July expiration, hoping for a bounce. I'm sorry, the July earnings, hoping for a bounce. Maybe you want to close out the position early. You know, you had mentioned that there are other income methods you could consider from your original position. Not really, because you don't have a lot of strike availability here. You know, we see the 10 strike, you know, it's trading at 90 to 135, but, you know, you're only going to gain 20 or 30 cents of time value because it's 90 cents in the money. Okay, it's 90 cents intrinsic. So we can look at it, of course, but I don't think it's a good play. It's going to put you at a larger loss potentially to the upside. So let's put that in at 110, for example, near the midpoint. Oh, well, see, now you've created, you've created a bearish position. So you'd actually want the stock to drop above 10, but you've increased your risk drastically if the stock recovers to the upside. So you don't want to try to force selling that call unless you are bearish on the position going forward through May expiration, which is only 14 days away. Okay, so that's just a brief review of some of the ideas you could do. Use the custom spread tool to play around with it. All right, Jerry asks, please explain the difference between radioactive trading and the tools on PowerOptions. Okay, well, the tools on PowerOptions, Jerry, let me just go ahead here. I'll just, here we go. The tools on PowerOptions, Jerry, are designed for self-directed investors. As you can see, we support patented search tools, analysis tools, profit and loss charts and other things in over 23 of the most commonly used option strategies: credit and debit spreads, calendar calls and calendar puts, covered calls, covered combinations, naked puts, iron butterflies, iron condors, just buying calls or puts, collars, straddle strangles, so forth, whatever, you know, most of the common strategies used by investors. And again, as we saw here with the married put, we can search in every strategy based on our criteria. We can search by symbol if we just wanted to look up positions in a strategy one stock at a time. And there's signature tools, things for volatility, the market sentiment tool, spread chain, long option finder, stock repair, and more. Okay? So this is a tool set, and of course the portfolios for tracking and managing your positions. That's PowerOptions. Okay? Our tools are designed for self-directed options investors, and we also provide a lot of education for all the different strategies as well. Radioactive trading is a concept developed by Kurt Frankenberg, which is based on using a married put position to open any strategy so you have a guaranteed limited risk in place. And after you have that position in place, you can apply various adjustments that are taught in the blueprint. 12 different income methods to adjust the position, potentially lower the risk, bulletproof the trade, and more. Okay, so this is sort of a full trading technique focusing on limiting risk first rather than focusing on a covered call position that may offer a 5% return, but you're still taking a 95% risk if the stock falls to zero. Okay, so we focus on limiting risk first. Radioactive trading, all the tools in radioactive trading are all based on that initial married put position. Now, we offer tools and PowerOptions for the married put for the radioactive trading strategy, such as searching for positions that match the initial concepts of the radioactive trading screening criteria. And as you're tracking the positions in the portfolio, just like any other strategy, you'll be able to see rollout opportunities and adjustments. So that's the difference. The radioactive trading focuses on one strategy, a limited risk strategy, which I actually employ with about 40 to 50% of my personal trading capital. And PowerOptions is your self-directed site, your one-stop shop for options investors. Okay? Okay, I'm going to do a real quick search here for Scott. Scott asks, if you have the time, could you construct a search for long puts? Looking for stocks with earnings coming up within 2 to 4 weeks. I'd like to spend 50 cents or less. Okay, not a problem. I'm going to show you the very basics of setting up a long put search for that with earnings coming up within 2 to 4 weeks. Okay, and then I'll let you fill in the rest of the blanks later, Scott. So first, I have to go to Other Strategies. For now, I'm going to take out Bull Call Debit, and I'm going to go ahead and add in long put. Okay, so let's save that configuration. Let's go to the long put screen, and I'll go to search. Now, whenever you have a specific search, such as Scott mentioned, I want to look for long puts, buying puts where earnings are within 2 to 4 weeks, and naturally the put expiration would be further out in time. Or I want to look for covered calls just on stocks that pay at least a 2% dividend, and the ex-dividend date is 2 weeks away. or I want to look for long calls on stocks that are trading above the upper 100% of their Bollinger Band range. Anytime you have a very specific search on that, the first thing we want to do is scroll down below the listed trades. When you first open the search, we want to hit Clear Filters. Okay, it's going to empty everything out of the parameter field. Scott has 3 simple criteria. He wants to pay less than 50 cents for the put option. Okay, so we'll go into the options section of our parameter field. Option ask price, less than 50 cents. For the earnings, we want earnings to be between now and 4 weeks from now. Okay, so I can't do 2 to 4 weeks, but I'm just going to say now and 4 weeks from now. 4 weeks would roughly be about 28 days. So now I know that I also want the expiration, or would need the expiration for the put option to be after that. So let's go to options again. I'm going to put my expiration time frame at all months. I'm going to set my days to expiration to be between 30 and, let's call it 75, okay, for the time being. But you can change that, Scott, later. So real simple. Put in your 2 main criteria. This, earnings coming out between now and 4 weeks from now, and you probably want your time frame to be about 30 to 75 days. Let's go ahead and submit that. Very basic screen. Now we have over 500 results. You've got a lot of positions here for the same stock, of course. But, you know, some of these are realistic but unrealistic. What do I mean by that? Well, just on the first one alone, AutoZone, currently trading at 776.21. Okay? And we see numbers here for the 490, the 480, and the 470, with options prices with 30 cents, 35 cents, and so forth. Okay, but these are almost 50% out of the money. Now, a little bit less now. Let's call it 35% out of the money. If the stock falls 10, 15, or 20%, this far out of the money, implied volatility is going to dry up after the earnings, and this is still going to be worth 20 cents or 30 cents. You're probably going to have a loss. So what we probably have to do is restrict this a little bit better to find options that are actually going to react with the earnings move, that we're not starting off with 65% out of the money. So I'm going to restrict this now to keep the 50 cents, but I don't probably want to go more than 20 or 25% out of the money. So I'm going to start with the percent out of the money range, blank, to 25, less than 25. Let's see if we have any results here. Okay, still a lot. Madison Square Garden, I think we should go lower. I think we should only go to maybe 15% out of the money. Okay. All right. Now, naturally, we saw AutoZone disappear. We saw some other ones disappear as well. Why? Because the options on that stock that are 15% of the money on a $700 stock, the put options that are 15% of the money, are probably going to be $2 to $3, much higher than 50 cents. You're going to be looking at some lower price stocks, and there's some high price stocks here as well. Walt Disney, for example, cheap ones there. Maybe we want to create another restriction, Scott, where I don't want to go too deep out of the money, where it's less than 20 cents for the bid to 50 cents. Okay, so I'll put that in as well. But you can change that any way you want to. So we're narrowing down the results, but there's still too many. So you're going to want to play with that. But the first 3 steps you do, clear the filters, set your time frame. You know you want it to be at least 30 days out in time. Set your option ask price to be less than 50 cents. And then, of course, start off with just between now and 4 weeks from now for the earnings date. And then what you'd also want to do, of course, for this particular search is go to choose columns on your long put search and make sure to select the earnings date as well as any of the other stock or put option information you'd want to see. All right, Mike asks a great question. Is it a bad time to be writing covered calls with stocks fairly high? Stocks are bouncing a lot. You know, we've seen that some are near their highs, some are near their lows. I hate to say this, Mike, but I don't trade covered calls anymore. Okay, I just don't do it. I spent about 18 months and then again later about 12 months trading covered calls in my career when I first started, because that's all I was allowed to trade for level 1 options trading. And going forward, of course, I tried it again later with different criteria. I never really got it to work. And it was because the simple fact that stocks that are falling, which is where your concern is, Mike, is that if stocks fall down, sure, you generated a premium, but if I have an 8 or 10% decline in my stock over a 30-day period and only generate 3%, I'm still at a 5% loss. It might take me 2 months of writing new calls against it to get back to break even. If you're interested in income, Mike, and you want to buy stock and you're doing covered calls, but you're fearful in the market right now, I would suggest that what you would do is start looking maybe at some long collars. Okay, long collar is very similar to a covered call. I'm going to buy the stock. I'm going to sell an at or out of the money, maybe 1 month out call or so. And at the same time, I'm going to buy a put option, the same expiration date and out of the money. Different than the radioactive trading techniques, we're buying in the money put that's far out in time, because that's more for projecting growth. But if you're looking for income on neutral to slightly bullish stocks, and that's your goal for a monthly return, start looking at the standard collar. Now, the first complaint is, well, I'm not going to make as much if I do the standard collar. That's right, but a standard collar portfolio over time should easily outperform a covered call portfolio because you have this guaranteed loss. And as many of you know, you're trading covered calls or cash secured naked puts. Even if you're slightly out of the money, or you sold your covered call slightly in the money for higher protection, you're going to have that stock that drops 25-30% on you at some point or another. Okay? With a collar, you could set it up so even if the stock dropped 33% against you, you're guaranteed not to lose more than 5% on your position. A simple search to start off with, Mike, go to long collar. Go to search. The default search that should come up is, sorry about that, it should be the initial values standard collars, which means buying the stock, selling a call maybe 30 or 40 days out in time, under 40 days out in time, buying a put that's out of the money with the same expiration. So for EA, I might buy the stock at $63.94, sell the 65.5 call at $165, and buy the May 61 at $126. Of course, you're going to say, well, you're not getting as much premium. You could sell the 64 call in Electric Arts and probably collect $2, and you'd be in a better position. Well, unless the stock drops 12%, 8%. Be a better position with a collar. You can still make what you'd expect return for a covered call. The max return if the stock goes above 65.50 and your sign is 3.1%, but your maximum risk if the stock falls to $58 or $57 per share is only 4%. And you can change these settings any way you want to. I mentioned that you want to keep the same expiration date. So call date, we want to be equal to the put expiration date. We want to be maybe, and if you wanted to use weeklies, you could as well. And now I'm going to change this maximum risk. I'm not going to allow the percent max risk to go above 6%. I'm going to say maybe the return at 2.5. Okay, so let's make that subtle change and go ahead and submit the search. All right, so now Tessero at 77.92, May 20th, 79.5 call at 150, and buy the May 75 put for 115. You generate a small net premium of only 36 cents, but again, the most you can lose is 3.3%, and you still have the potential to make 2.5% return if the stock goes above 79.5, just like an out-of-the-money covered call. And if you wanted higher premium between the call that you're selling and the put that you're buying, just put that into the field. So we want the net premium, let's say, to be at least 50 cents. Okay, so I'm still generating a positive premium to maybe cover more of the commission costs, and this will take your risk down to 166. Okay, so I'm not a covered calls trader anymore because of the downside risk. Most of my portfolio, again, is in the married put trades where I start off and the position has an unlimited upside profit potential. But I also do these long collars, these standard collars, with about 15 to 20% of my portfolio as well, and I have since about 2002, 2003. And they've worked pretty well. You do have to be right more often than you're wrong, but you don't experience the sort of management you need with covered calls when you have those stocks that have dropped 10, 12, or 15% against you, okay, because you've got a locked-in gain. Okay. Now, Luis says, if you have a low trading account, probably spreads or covered calls. Well, most investors who have a low trading account, and Luis, I don't know what you consider to be a low trading account, but if we're under, let's say, $10,000, most investors I talk to will be doing maybe 2-point spreads, the credit spreads on their positions to use the margin. But we always have to remember that leverage works both ways, doesn't it? What do I mean by that? Let's go to bull put credit. I'm going to go into search. I'm not going to use weekly options, although you can. And here's the weekly screen that came up that we were doing on one of our last webinars where I'm looking at indexes that expire 7 days out or so. But what I'm going to start off with is just the, or maybe I'll go to weekly bull puts. Let's see if we've got that there. This is just a default search, Louise, that you can use as a stepping stone to create your own personal search. Okay. All right. Okay, so yeah, these are 14 days out. These are standard May expiration. What we found historically testing, by the way, is that when you're doing credit spreads, even though weeklies are available, we've run various historical tests and historical screens. So this default one has been historically tested and performs better than trying to find spreads that are 4 or 5 days out in time. Because if you're entering just the 1 week spread, you might only be getting 10 or 15 cents for a reasonable probability. I mean, above 70, above 65 is a reasonable probability. Actually, above 80 is probably better. But you're only taking in 10, 15 cents. So when you have a loss, which will happen, it amplifies because you didn't collect as much up front on your other positions. So by going out to the 2 week period, we see better credits of 30 cents, $1.10, 27 cents, 18 cents, mostly on 1 or 2 point spreads. Now let me find a good position here. I think I like this Facebook one. It's got a high probability of above 80%. Facebook's at 119. On my bull put credit spread, Louise, I could sell the 20th of May, 14 days away, 115 put, so about 4.5 strikes, 4.5 points out of the money for 65 cents. Now, I can buy the May 113 put for 39. This gives me a credit of 26 cents, and it's a 2-point maximum risk. So what does that mean? It means I'm pretty close to about a 9-to-1 or 8-to-1 risk-reward ratio. Whenever you're doing a credit spread and you're looking for a probability of 75 or 80% or higher, you're going to have a 9-to-1 or 10-to-1 risk-reward ratio. That's just the way it's set up. Okay, so is that a bad thing? Not necessarily, if you can be right more often than wrong with the spread positions. So if I open one contract of this trade, naturally my leverage is going to be very low. I'm only going to need $200. In reality, most brokers will only charge me $174 to open this trade. But I can't do just one contract because I only collect 26 cents. My commissions might be $15, so I've taken more than half of that to pay the trade. So I'm probably going to have to do 5 or 10 contracts, but that's still only $1,000 or so into the position if I used 5 contracts, okay? So that might be pretty good. We get about $130 in. 15 of that might be to commissions, so we're still making 115, risking a little bit under 1,000, so we still have a reasonable return of about 15%. And that's good. Except for if something comes out on Facebook in the next 5 days and the stock drops from 119 down to 111, or it just gradually moves down and you don't adjust the position, and as soon as you look, it's trading at 111 and you're at the maximum risk. This one loss would wipe out 10 previous trades. Okay, if all of your trades, you set up 10 or 12, let's say I had an account of $10,000. I allocated $1,000 because I wanted to open 10 trades. And we took in, this 5 times, or let's say our position was taking in $1 premium for risking 1,000. Well, if I open 10 trades, we take in $1,000. Okay, and if 9 of those trades work the way we want, but one moves against us, and we close it out for near the full loss, we were right 90% of the time and came out of the month at break even. And that's the gamble with the spread trades. Leverage works both ways, okay? And so that's what we have to look out for. And of course, with the long call positions, that's another leverage position. I can just buy a call or buy a put instead of buying the stock. And in that situation, your maximum risk is what you go into the position. What's really important there, Louise, when looking at credit spreads, because you have the lower size account or just buying calls or buying puts, speculating on a market movement, is discipline and control. Okay, you've $10,000 to trade, you're bullish on a stock, you see that there's a call that's trading for $1 or $100 per contract. The last thing you want to do is buy 50 or 100 contracts and put up $5,000 or put up $10,000 into that one play. Any position that you open, the monetary at risk, the maximum at risk should not be more than maybe 5% of your total portfolio value. Okay, so if this trade suddenly went against me, if I had a $10,000 trading account, I'd probably only do maybe 3 or 4 contracts, maybe only 3 contracts of this position if it matched my monetary goals. Why? Because if my maximum risk is around, with 174 times the 3 contracts, it'd be about $522 total. of my $10,000 account. So if this completely went against me for an unexpected event, I've only lost 5.2% of my trading capital. I can withstand that. But if I traded 10 contracts and took this up to $1,740 at risk, 17% of my portfolio in the stock fell and I lost on that credit spread, or I bought a call on Facebook and the stock fell and I lost the entire amount of 17% of my portfolio because I put in that $1,700 of my $10,000 account, that's going to take me a long time to get back to break even. Okay, I'm going to pause for a brief second. Morris's question is up next. What I'm doing now is scrolling through here. All right, and so Louise said, yeah, I like to do spreads that are a couple weeks out. Trade weekly options, get in and out within a week or two. And that's good for you, a management technique, so you won't get stuck there. Okay. Let's see. Real quick follow-up question on Mike. I'm going forward here so I can see the follow-up questions. He said, do you recommend standard collar over income method number 2? Mike, I approach the standard collar in the radioactive trade as 2 separate positions. The standard collar you and I just reviewed is based, and this answers Jerry's question as well, what types of stock pattern is suited for married put and long collar, okay? When a customer asks me, I really want to trade covered calls, I want to generate income on a monthly basis. If I start talking about married puts, they'll probably tell me, and this has happened, and I accept it. They'll say, no, you're not listening to me. I know what you're doing over at radioactive trading, that you have a better protected position, but that's a long-term trade. I want in and out in 3 weeks, and I want to generate income, but with protection. That is the true definition of a long collar. You get the benefit of the covered call. You get the protection of the married put. You're not necessarily planning on staying in this stock for the long term. If I do a 2-week out collar trade or a 1-month out collar trade, if the stock moves up above the short call strike price, I get assigned, I make the maximum return, I look for a new collar. I don't worry about rolling it and rebracketing the position necessarily unless I think there's opportunity for further upside. If the stock falls below the put strike price, am I going to manage the position? Likely not. I'll take my 3 or 4% loss on the collar for that 14-day or 30-day trade and look for a better collar with a better performing stock rather than what we all have done with a covered call position. Let's say this is our collar and the stock fell, so I let the call expire, I sell to close the put, and now I sell a new call and buy a new put further out in time. Well, then this is still a bullish strategy, so if my stock continues to fall, I'm just doing the same thing over and over to where my profit line is up here even if I get a sign, if the stock recovers. We've all seen that with covered calls, the same principle of the collar. So if it drops down, I'm most likely just going to close it, take the 4% loss, and look to make that back with a new collar that has better bullish parameters going forward. With the married put, when I open a married put, it's for a longer term hold. I'm going to be in my radioactive trade, my married put trade, on average for probably about 120 to 140 days, okay, 3 months to 4 months roughly. I'm buying a put that's 7 to 8 months out in time on average. I'm in each position for 3 to 4 months. My goal is that I think the stock's going to move up 4 to 8% within the first 30 days, and that has a potential to move up farther. So Jerry's question is, what do you want to do? What are the criteria between the two? To me, Jerry, a standard collar criteria is the same thing you'd use for a covered call. Something that looks like it's going to be neutral to bullish for the next 15 to 30 days, and you like the premium. But rather than take the chance of the stock moving against me, I'm going to enter that as a standard collar. There we go. I'm going to enter that as a standard collar where I have a guaranteed risk and can still take advantage of the premium. If you're long-term bullish on a stock but you want protection in case you're wrong, that's when I do the married put and apply the income methods. So to your question, Mike, is income method number 2 better than a collar? I look at them as 2 separate things. One is for monthly income. Okay? My married puts are more for growth on stocks I'm more bullish on over time. My standard collars are shorter term trades that allow me to enter a trade similar to what we'd see in a bull put credit spread risk reward profile or a bull call debit, but without taking on that 10 to 1 risk reward ratio. Okay, so I'm just going through there as well. And Jerry, yes, we already showed that. I'm in the married put search right now. As I mentioned, this is the predefined criteria that I use to open my married put positions, and Ernie does as well. I also have other ones. So it's just the criteria we use discussed in the blueprint there, limiting the risk, looking for the expiration time frame we want. This is the exact criteria that Kurt used, most radioactive traders use, and Ernie uses as well to identify new radioactive trades, Marion put positions, okay? Oh, and Sam mentioned something. Let's go back to our Facebook position here. Let me go to the profit and loss chart very quickly. Yes, Morris, I'm getting to your question. I do apologize. I wanted to make sure that I'm not missing any questions that were related to what we asked. Morris said, if you buy a put with this spread, then it could be better if Facebook drops. True. And I have a lot of questions that come in from investors who, when they see the ideas of the Mary put, they say, can I bulletproof my credit spread? Can I bulletproof my debit spread? Well, the answer is yes, but only if you leg into the position first. Okay, if I buy a put now on this Facebook position, whether it's near term or whether it's further out in time, I'm no longer going to be in a credit spread. Okay, all right, that's the case. Okay, so if I go in, let's see, we were at May 20th. If I go back into May 20th, I've already got one put sold, one put bought. Let's say I buy a cheaper put at 108 for 10 cents. Okay, now, how is this going to change the dynamic of my position? Let's talk about it. Well, I'll put it in 11 cents. Well, my net credit is cut down to where doing one contract would be impossible with 3 legs, because that would, you know, take care of all my, that wouldn't even pay for my commissions probably. If I did 2 or 3 contracts, you would have to get higher. The risk increases, and I'm still in a bullish trade, but I didn't really help it here by doing this, unless the stock really falls like Apple did down to the $90 range. That second put won't take over. So now I say, okay, let me buy a higher strike put. What's going to happen there? Okay, let's buy the 116 put for extra protection, about 88 cents. Okay, so we take our bull put, we add a higher strike put. Well, now we're at a debit. And what's the problem here? You've turned a bull put credit spread on a stock that you were bullish on into a bearish position. Your profit's to the downside. You have a loss if the stock stays above 119 or moves higher as you expected originally. So now you're trading against yourself. So applying protection to a bull put credit spread, a bear call credit spread, or a debit spread is very difficult. It doesn't work the same way as it does with owning the stock outright. And you can even protect a long call better than you can a credit spread. If I have a long call that's up, I can buy a cheap put, and that would lock in some of the gains, okay? But that's a whole different thing there as well, okay? So, you know, adding a put would protect it. You're absolutely right, but you've got to be very careful. And then you might only say, well, we could do a ratio. I could sell 10 and buy 10 of my bull put and just buy 5. You know, now we're getting into ratio spread range here. We still don't have a credit, we have a debit, but now it's just still not what we wanted. We were here. We thought the stock was going to stay in this range for the bull put, so our protection has turned this into a neutral position where we're pinning that the stock would be trading right at 115. So protection doesn't work the same in all strategies. And you always want to graph it first before you do anything, because you can easily end up trading against yourself. If you're looking to protect a bull put, you say, oh, well, I hear these guys talking about insuring their portfolios by buying a put against their stock, or by buying calls on the VIX in case there's a large market turnaround or things of that nature. Make sure you graph it first, because you might end up trading against yourself and your original expectation. Yeah, you've got protection in place if the stock really falls, but if the stock did what you initially wanted to, well, then we're stuck in a position that's against our original point. All right. Okay, so Morris's question is the underlying thought that probably all of us have had at one point or another, and it's been nagging us. Everyone who's online today, everyone who's ever been a customer of Power Options, anyone who's been a customer of any options service, anyone who's ever traded options. Okay, the fundamental question: why hasn't somebody come up with an algorithm on the Greeks? For those of you who don't know, we're talking about delta, gamma, theta, the movement of the option, okay, that combines them all into one dynamic number that fluctuates appropriately with time as it relates to the current option price. If somebody could develop and patent such an algorithm, they'd be an overnight millionaire. Yes? No. They would not be an overnight millionaire, Morris. Okay, here's the reason why. The Greeks are derived on an expectation of what should happen if X or Y happens, okay? Meaning that there's no guarantee that X or Y will happen. Let's take a look. Okay, I'm going to the portfolio tools here, and I'm going to look at what we call the Greeks view here in my portfolio. And we're going to review the Greeks very quickly just by name and definition, and then we're going to, I should have just stayed somewhere else. Okay, so the main Greeks, we throw implied volatility in here because it's related to it, but the main Greeks, of course, are delta. That's the main one. What is delta? Delta, of course, is the expected movement of an option price based on a 1-point movement on the stock price. So, better way of doing this. Okay, I was going to show it here because I wanted to show this position I entered the other day here on Foot Locker and radioactive trading. But I'm actually going to go to the option chain, and let's just go to, we're just looking at Facebook. Okay, I'm going to go to chain. All right, I'm going to customize our call and put chain. Okay, for us here. Let me just clear some of this up. First thing I'm going to do is just select the standard May 20 expiration, 14 days out. I'm going to leave it at calls and puts, but I'm going to choose columns. All right, this allows me to customize what I want. Now I'm going to need some basic views in here. I need the option strike price. I'm going to need the bid and the ask. I don't need volume right now. Don't need open interest. I'm going to use implied volatility. Don't need protection, percent if assigned, percent in or out of the money. Yeah, I do need percent in or out of the money. Naked yield, break even. Okay, so I'm working on the call and put side here. Not going to do volume, bid and ask. Okay. Now, I'm going to add the delta, gamma, theta, vega, and rho into both legs, okay, so we can see it. Let's submit and save our columns and move forward. Okay, so we're on the small chain here for Facebook, which is at 119.49. We could say the at-the-money options are the 119 to the 120. All right. Again, delta is the expected movement of your option based on a 1-point movement on a stock, 1 point up. Calls are going to have a positive delta. Your at-the-money options are always going to be around 0.55 or 0.50. I'm sorry. If Facebook was trading right at 119, our 119 call here would have a delta of 0.50. Expectation is it's going to move up 50 cents if the stock moves up 1 point. Your put options will have a negative delta. Okay, so that means if the stock moves up 1 point, I would expect to lose 45 cents or 50 cents or so on my 119 to 120. Okay, now as you go deeper in the money, strike prices below the stock price for calls, your delta gets closer to 1. And as you go out of the money, your delta gets closer to 0. Okay, and reverse with the puts. As we go in the money, meaning put options with a higher strike price, our delta gets closer to 1. And as we go out of the money, delta gets closer to 0. Okay, is this always accurate? Well, no. Options with a shorter expiration time frame are probably more accurate with their movement to delta, but options that are 3 or 4 months out, if I have a delta of 0.5, my stock moves up evenly 1 point, my option might have only gained 40 cents. Okay, whereas I might have another stock where I have a delta of 0.5 with a 3-month out call, and the stock moves up 1 point, I might actually see that call go up 55 cents. Why? Because changes in the other factors, implied volatility. Maybe one stock implied volatility decreased, where the other stock the implied volatility increased with that 1 point movement. So one option would gain more than the other, even though they both had a 0.5 delta and both had a 1 point movement in the stock. Okay. Now your gamma, let's say that my stock, let's say on the call side here, let's say that we bought the 119 call with a delta of 0.55 and the stock moved up 1 point to 120.50. Well, I'd expect that this option at 235 would now go up to 290. It would gain 50 cents. But would the delta remain the same? No. The delta's got to change too for that 1 point movement. What is it? It's the gamma. So now that the stock moved up 1 point, if my option did gain that 55 cents that is now trading at about 290, my new delta would be at 0.62. It had moved up 0.7. And we can see that going down the line. The next one in the money is 0.69 and so on and so forth. Okay? But the gamma measures how much I'd expect the delta to change with that 1 point movement. What if the stock only moved up 50 cents? Well, I'd expect my delta, my option to gain half, maybe 27 cents, and I expect my gamma to go up 3 or 4 to about 58 or 59. Okay? What is theta? Theta is the measurement of decay. In other words, how much can you expect your option will lose value between now and expiration if the stock stays at the same price? And so with theta, what we're looking at here is if I sold this call right now at 231, it's 50 cents in the money. So my time value is going to be about $1.80. So for the next 14 days, I'd expect a decline of about 8% per day, 8 cents, my apologies, 8 cents per day, 0.762. Okay, that's what that's telling you. This is based on the assumption that the stock stays at the same price. Volatility and implied volatility on the option remain the same for the next 14 days, which is not going to happen. So this is a projection of A, B, C, and D. Okay, is that this theta decay expectancy only works, the stock stays at the same price, implied volatility and historical volatility remain the same. If the stock fell to 113, my call option would probably go down to about 35 cents or so, about in this range here, but 6 points out of the money, go down to about 35 cents, and then my theta would probably go to 2 cents, right? It would change. My delta would now be around probably, we'd be in this range. It would be about 0.16. Gamma would drop to about 0.5, and we'd be losing about 3 to 4 cents a day instead of 7 or 8 cents a day. Okay. Of course, you can see all of these, by the way, if you just hover over the definition there. Okay. Vega, the next one, this is the sensitivity of an option's theoretical value to a change in volatility. Okay, so if the volatility shifts, moves up a point, or was it a tenth of a point? I'm sorry, it's a point. Okay. Then what that means is that you'd see the option price change. The Black-Scholes value, not necessarily the options price, the Black-Scholes value would change based on the movement in volatility by 9 cents. Okay, and it's pretty even across the board. That doesn't mean the option is going to actually move. It doesn't mean it's going to move by 9 cents. Demand, supply, market maker's preference, bid-ask spread, interest, of course, open interest and volume, supply and demand, is going to dictate the price more than what Vega did. Okay? It really is. If something happens, the stock moves down a point, the implied volatility gains 1/10 of a point, we might not even see the option move. The call option might increase rather than decrease, or vice versa. Okay? That's one of the things we have to take into account. Rho is very strange. It's the sensitivity to the change in interest rates. Most people don't really worry about that unless you're really sensitive to the interest rates. You really know what's going on. You're really monitoring the interest rates, and you're playing sort of a currency game or currency hedge trading. All right. Okay. So your theory is sound. Your question is sound, Morris. Do not get me wrong. I hope that doesn't sound like I'm coming off with that. But what I'm saying is that these are projections of what should happen. Again, I can have two of the same stocks right now, okay? And these two stocks might be trading at 119.49. I'll look at the 14-day out 119 call for both. Both are, let's say both are priced at 235. Both have a delta of 0.55 and the same Greeks. If both stocks move up on Monday by $1, I'm not going to see the same price on both options. Why? Because implied volatility is going to change. One stock may drop in volatility, the other may increase in volatility. How could that happen if they both move up 1 point? One might have moved up a point just on general volume, and it looks like a stronger stock now. And I know 1 point's not that much, just using it as an example. The other one might have moved up a point based on a buyout rumor, or someone just did a large volume trade out of nowhere. It was a one-block trade. So now there's a little bit more speculation on interest and something going on. So you can have two stocks with the same exact price, both move up $1. One's volatility might decrease, one's might increase, which means the delta would change by more than 0.55 for the implied volatility that increased, as with the gamma and the theta, whereas the other one might be in line with this. Okay? So is there an algorithm we could plug all of this in and at the same time plug in market sentiment, change in the markets, speculative futures-looking volatility, the VXX, for example, what is going on 2 months from now or even 3 weeks from now, would that affect these 2-week out options? What I'm saying is someone could create that, and someone could sell it, and someone could say, hey, we've worked out this algorithm that it points to this option, these stocks will always move up because of the options here moving and changing price and doing all those things, okay? They could do that, and they'd sell it, and people say, oh, this is just what I've been looking for. You solved the holy grail. And what you'd find out when you actually trade that is that maybe it does react close to it, but when you're playing a game of Greeks, which really means you're playing a game for hedging and skewing with trying to get 3 to 5 cents here, 4 to 5 cents there, a gamma hedge or a delta hedge of maybe 0.10, which relates to 10 cents really, that kind of information. If you miss by 5 cents, say, I only missed it by 5 cents. Well, that's 50% of your projection. If it goes the other way, you lost 50% of what you expected to make on that hedge itself, okay? So that's what we're kind of looking at as well. That's why it's difficult. I'm going to point you to one more thing that's maybe not as in-depth as what we just covered right now. But in our free webinars tab, and I encourage everyone during these webinars to take a look through these free webinars. It's www.poweropt.com/webinars.asp, okay? That's the free page. You don't need to have an account. You don't need to be logged in to access it. In the tools section here, in the options concepts, there's a listing here of Greeks and why you may not need them. Okay, because a lot of times I don't use Greeks at all when I'm trading, believe it or not, and I'm successful. Okay, I'm pretty successful compared to people that I've talked to. I'm not the most successful investor, I know that by far, but I profit regularly. I match my goals regularly, and I don't use Greeks at all. I really don't. Maybe that's because the strategies I'm using are more protected. I'm more focused on the amount at risk, what I could lose on the position, and looking for stocks with certain fundamentals. The only time I use Greeks, when I use delta, delta ratio, and occasionally I'm aware of gamma, is when I do diagonal spreads. And I do those with about 10 to 15% of my trading portfolio from time to time. I'm not in them right now. I'm looking to redevelop the calendar spreads. That is the only time I pay attention to it. Okay? There's a description here. You'll see it in this webinar where any strategy I'm looking at, whether I'm looking at bull put credits, bear call credits, or married puts, or even covered calls, that if I put in the criteria for a reasonable position, I'm already screening by the Greeks by not paying attention to them as well. Okay? All right. So what do I mean by that? Let me show you real quick here. I'm going to go to married put, and I'm going to go to search. I already talked about this with Jerry. We list the default criteria that we use for radioactive trading. I always get this question during webinars, do you screen by delta or implied volatility? No, I don't. The active filters for the default married put search, we want puts that are at least 150 to 900 days out in time. We want to keep the risk to be between 3.5% and 9%. We don't go more than 20% in the money because that would hedge us out too far on the put. So I'm buying a stock and I'm buying a put that's probably 6 to 8 months out in time. My personal risk is between about 3 and 7.5%, and I'm usually less than 15% in the money with the put. I want stocks that show some good average stock volume, have a reasonable volatility, stocks trading in an uptrend, reasonable price range, and stocks above having a 5% earnings per share growth. Now, here are the top 14 results that match that basic criteria. All right, I've selected delta, and what do we notice in the delta field? My highest absolute delta is 0.67. My lowest absolute delta looks like to be 0.46, which is lower than I'd expect, but it's 0.46, and that's an in-the-money 120 put, which is interesting, okay? So that is a very restricted delta, but I did not even use delta in my filters. I also added implied volatility on the right-hand side here to illustrate this. On the implied volatility, my highest is about 0.4715, it looks like. My lowest, I think, is right above that, 0.2388. So that's only an implied volatility difference of 0.24. That's a very small range, but I'm not even screening by implied volatility. Why is that working? It's because that I set the system up to find specific puts that were less than 15% of the money and have the risk that I want. That automatically took care of implied volatility, delta, and gamma. How? Because if the delta was too low, it would have a risk higher than 7%, right? Low delta, remember, would mean out of the money put, or I'm sorry, out of the money put, which would have a much higher risk in the range I don't want. If the delta was too high, it would be too deep in the money. I hedge myself out of the position, so it would have a risk of less than 3.5%, or it would be more than that 20% in the money I wanted to see. So I'm already filtering by those without it. The implied volatility just means the higher the IV, the more inflated the premium, which means the higher risk. I filtered that out. Okay? Higher delta meant lower risk and deeper in the money. I've already filtered that out as well. Jerry says, will volatility skew put my married put trades in disadvantage? Can timing and IV improve advantage in the naked put or married put? No, I don't think so. Because when I open a married put, I'm using a put that's further out in time. Okay, I'm going at least whatever, 180, 250 days out in time. A volatility skew is simply, the volatility skew is simply allowing you to compare the volatility in the near term to the far term, okay? But that's not really going to help you. Let me do a time skew here at the money strike. Let me go in the money a little bit. Maybe let's go to a 95 put. Okay, so what I'd open is a married put right now, maybe on Apple. Okay, so the put implied volatility here. Well, right now it's of course pretty high at 0.35 and it stabilizes over May, and then as we start going further out to January, the implied volatility starts increasing. Okay, does this mean that what I should look for is implied volatilities further out in time that are lower? Not necessarily, because your projection isn't so much of how can I manipulate the put in this short time frame as opposed to my growth. And does this volatility skew here with a higher implied volatility further out in time imply that Apple's going to move up? No, it's implying that Apple might move, that the market is expecting it to move in a certain time frame, but it could be up or down. Okay, that's not real. This is not a bullish projection or a bearish projection with the volatility skew. I know people try to teach that, but I've never seen it consistent where if I grabbed 10 stocks that had this chart pattern where we see the low volatility at 0.23 here, and going out to January, we move up to 0.3, 0.35, or 0.31, okay, to January 2018. A small move, right, 0.23 to 0.31. But they might say, oh, because the volatility is higher further out in time, that's a projection that it's going to move up. You give me 10 stocks that have this same chart, I'll probably show you 5 that move up and 5 that move down. From between here to January 2017, or even from here to June or July of this year, then to January, and then to January 2018. We'll see 5 that move up and 5 that move down. The movement on the stock is not really based on the volatility in the projection. It's based on what's going on in the market. Did the company foul up during that time frame? Did they do really well during that time frame? That's what it comes down to. This time skew, I would only consider, again, with things such as diagonal spreads, calendar spreads of any kind. If you're opening a, if you're opening a any kind of ratio spread that's also a calendar. If you opened a married put and bought a shorter term put, maybe that I want my shorter term put to have a lower implied volatility than my higher one, but I don't do that often. Sam says it's a market sentiment. Yeah, and there are people that teach the volatility skew as a market sentiment, but I have not seen someone get it right consistently, to be honest with you. Sam, if you've got insight on that, let me know. But of all the people I've heard try to sell volatility charts and volatility tables and things of that nature, it's just as reliable as looking for a volatility smile projecting the stock's going to move up in 6 months is just as reliable as looking for a positive earnings per share growth on a stock and expecting it to move up in the next 6 months. Or looking at a MACD crossover where it only crossed over in the last 3 days, projecting that means the stock's going to be bullish for the next 14 days. Okay, no one's found the Holy Grail as far as I know, and that's why we keep trying it. But to me, the volatility skew, especially the time skew and the strike skew, is more geared towards things of the diagonal spreads and when you're using different expirations. If you open a married put, someone had mentioned this earlier with income method number 2, I believe it was Mike, said that if he had done a radioactive trade with that far up on the put, would I recommend doing that and doing an income method number 1 or 2, selling the call right away, as opposed to doing the standard collar. Now, if I was creating a portfolio where I consistently bought the stock, bought the in-the-money put, and sold an at-the-money call, which actually creates a bearish position in the first 30 days, if I was doing that type of trade, I might pay attention to the time skew because I'd want the near-term option I'm selling to have a higher implied volatility than the far option that I'm buying. Okay? And that's not for projection of movement. That's simply for trying to get more premium, an overvalued premium when selling and an undervalued premium when buying. And that's kind of the case there, okay, with the volatility skew, in my opinion. But if you do have other insights there, you let me know as well. Scott, you might want to send us an email on this. Scott says, could you folks consider creating a way to allow alerts to stay active? I don't know if you mean the portfolio alerts or if you're looking at something else. So you might want to clarify that with an email after the webinar is done. Mike says, do you do anything to avoid volatility crush with married puts? Well, again, I already discussed that. Another factor, well, I didn't really discuss it. Didn't mean it to sound that way. Remember we looked at the married puts here, Mike, and I showed you that my implied volatility is already in a tight range. These are low volatility to give me the risk that I want, the implied volatility in the puts, so I don't expect a large move. Okay. One other thing I could add in here is if I go to choose columns, and I have done this in the past because it burned me once. I'll admit honestly, it burned me once. What I'm going to look at here is the percent implied volatility range. And the other thing I'm looking for here is implied volatility total. It's not there, but I'm going to look for the percent implied volatility range. We're going to be able to do that here. Let me save and submit that. What the percent implied volatility range shows you, Mike, is where is the option's implied volatility now compared to where it has been over the life of the option. Okay. Now that one we were looking at on Cambridge display, the one with the highest implied volatility, it's currently at 71% of its total implied volatility range. Well, that could mean a couple things, couldn't it? Number one, if the implied volatility range is only from 0.43, since this option was released on the market, to 0.48, yeah, I'm at 71%, but I'm not worried about any kind of crush on this. It's been open probably for at least 100, it's a leap, so it's been open for probably at least 300 days. And if it's only moved 0.43 to 0.48, I'm not worried about a crush at all. But your point's well taken. If the implied volatility range is 0.10 to 0.51, and this now at 0.4715, yeah, I might be concerned that it would go back to 10. But remember, that doesn't affect the loss. My maximum risk is still the same regardless of what the implied volatility does. What it would make difficult in a volatility crush of this kind, if that was the scenario, Mike, is that rolling the put with some of the income methods would be more difficult if I open the position and then it dropped in implied volatility. But one of the reasons why we're buying the put option further out in time is because these further out in time put options aren't as sensitive to near-term changes. But let's take a look real quick. I'm going to go to the More Information menu. I'm going to go to Research and Option Research. And we were close, weren't we? That's pretty good. We are currently at 71% of our implied volatility range. The implied volatility range is 0.18 to 0.59. So this might be a concern, Mike, that there might be a volatility crush on this position. Can we avoid it? Absolutely. Oh, sorry, absolutely. Let's go back to our filters. And I've done this before in the past. Percent implied volatility range, I want to keep it less than 60%. Okay, so we've just narrowed down our list to show only those put options where the percent implied volatility range is on the lower end of the scale. So if you're worried about implied volatility crush, something you can add in there right away. All right, question came in here. Ted says, how can you fund a married put position if your account is less than $10,000? Margin? No. If you use margin, then you're defeating the purpose of having the locked-in loss. Sorry, Ted, I need a quick drink there. I started trading, when I first was introduced to Kurt, I only allocated $7,500 of my trading capital to radioactive trading. That dictated that I was only opening 3 or 4 positions at a time, mostly at 100 shares, but occasionally at 200 or 300 shares. And it dictated that I was only looking for stocks below essentially the $30 range, which you can do. But here's what you want to start off with, Ted. We don't advise doing it, but you can start off. If you're just allocating $7,500 or $8,000 or so, and let's say, what do we know from the basics? Let's say you wanted to sample this out with only $8,000 trading capital, and you wanted to get a good range of it, so you know you want to do at least 3 or 4 trades at a time. You have 3 or 4 married puts open at a time. Well, that easily dictates to you that you can't look for married puts on stocks above $25 per share. Because if you did a $40 stock, that would take up 50% of your account with just 100 shares. And yeah, you could do 2 more in the $20 range. What I did with my $7,500 is I made a couple adjustments. I kept everything the same. I want the puts to just be 150 to 900 days out. We'll leave our implied volatility range. Put my risk to be less than 7.5. But see, this is the criteria I want. I want to be far out in time, limited risk, decent range in the money. Those are the 3 core principles of radioactive trading. Okay. Now, I got to adjust my stock price range. So I'm going to just look for stocks between 5 and let's say $35 per share. I'll go to the higher end, which would be about a third, a little bit more than a third of my total portfolio value. Okay, but let's go ahead and submit that. All right, and we just get 1. Okay, one of the reasons why is that Kurt and Ernie prefer to limit their stock selection to IBD and CAN-SLIM so they don't have to put in other criteria for maybe mid to large cap stocks or things of that nature. But here's what I did. I went into lists, took that out, but then went into the fundamentals. And in addition to stocks having a good earnings per share growth, I want a relative PE ratio of maybe 0 to 50 or 0 to 70. This is a market cap here. You can hover over and see what it is. I wanted only mid to large cap stocks in the lower range. So I went 2,000 there. Technicals here, I want an increased average stock volume. I want stocks that trade at least 750,000 shares per day. And I may have used a broker rec of less than 2.6 or less than 2.8 and stocks trading in an uptrend. Could also use technical indicators later, but let's just start off with this. So by taking out the list, what I did is I added some other criteria there on what I look for in a bullish stock. Okay, same thing I look for when buying a stock position. Okay, so now there's 19 total results. Morgan Stanley, Zions Bank, or a lot of banks in here. HD Supply Holdings, I believe that's Home Depot, sorry. Nothing really stands out here. E-Trade Financial, that's a good one, 24.93. That's one I've thought about trading before, and I think I did trade before for Fusion subscribers in my personal account. So this is how I started off. And a lot of the married puts I opened were $15 or $20 positions that some would, well, my best position, some of you may be tired of hearing Kurt talk about it occasionally in the twice weekly webinars, was Silver Wheaton. And I can't remember the exact year. It's in my historical trading record on Fusion, but I think it was 2009 or 2008. I got into Silver Wheaton at $17 per share. You think, oh, well, that's a terrible trade. It's trading in the $12 to $15 range now. You lost money. Well, when I entered it, I bought it at 17. In the next 6 months, it went up to $42 per share. So I had over about a 68% return on that married put position. Now, here's the trick, Ted. Because the married put gives me unlimited upside profit potential to start, and I'm not capping it by selling a call, it was much easier for me to ride that Silver Wheaton position up. So think about it this way. I did this position, my Silver Wheaton position, with 300 shares and 3 puts. It was about a $5,100 investment. And when the stock went up to 40, well, now I'm in a range where I've got much more money on the position, over $10,000 when I close the position out. Not $10,000 of profit, mind you, but $10,000 of value in the position, 68% gain on it. So where does that leave me? That leaves me with more money now that I opened it up more and started trading $40 and $30 stocks. Okay, more $40 and $30 stocks and radioactive trading techniques because of a couple of winners. That's possible. And again, I'm just going to say that we don't necessarily recommend that. We do recommend starting off with at least $10,000. If you're in the $7,500 to the $5,000 range, you can find married put positions easily with power options on stocks that are within your price range. Wow, how did I lose that? There it is. Okay, so you can adjust it the way you want, but at the same time, that's what we're looking to do. Let me check something here. I think, shoot, my apologies. I know we're a little bit past here, and I think I've answered all the questions that I've had that have come in. If you think I missed a question, let me know. There was someone who was here earlier and had to leave, and I don't know if they managed to come back in, but they did ask. Oh, he didn't. Okay. So I'll have to answer Nathan later. Nathan's question was, I'm a futures day trader, know very little about options. Can you point me in the right direction to learn? Yeah, it's just different concepts, but it's very similar concepts. It's just without the margin requirement you have on most futures contracts. So yeah, I'll email Nathan individually later, but I don't day trade with options. I know there are customers who do. I just don't bother with it. I look for more at least 14-day out trades for my speculative credit spreads and so forth. Income strategies going at least 10 to 14 days out in time with those. Maybe further with a standard collar, for example, if the price is not where I want it to be, the net premium is not where I want it to be at that time. Okay, so that's one of the other things I tend to look at in that situation. Yeah, so again, I'm sorry, if anyone has any last-minute questions, go ahead and send those in. And if I happen to miss your question, someone emailed in last week and after the webinar and told me that I missed their question, they never got a response. and they're disappointed because I said during the webinar that all questions will be handled. Well, what happened was the customer unfortunately emailed me the question at 4:24, and I was already logged on to the webinar. I didn't check email during the webinar naturally, so I didn't even see that he sent a question. But if you did send in a question through the question pod and I didn't address it, go ahead and resend that to me real quick, because it's possible I may have accidentally deleted one as well. Sam says, where do you see institutional buyers buying stocks in Power Options? You can see the institutional holding on the stock research page. We showed that briefly. Let's hold on one second here and go back. So anytime I'm looking at Power Options, of course, if I'm on the search, we were before. There we go. Sorry, folks. I go to Expedia. I'll go to research, and I'll go to stock research. Okay, you can also access this by just typing in a symbol here and clicking on quotes up at the top line. If you want to see institutional holding, use the more information button to go to research, or just put in your stock symbol, click on quotes. It'll take you to this page. And so over here on the left, you've got a lot of things available here as far as some of those criteria go that we're talking about. I'm sorry, I've got shares outstanding, the days, the short interest amount, the days to short interest, held by institution right there is the held by institution value, market cap, of course, open shares, things of that, shares outstanding, I'm sorry, I meant to say. So that's where that data can be found, at the held by institution. We don't offer it as a filter in the search tools, and I don't think it's available as a criteria to view in the search column results, but you can see it very quickly in that research tool there for the number of held by institution. Is it show recent buys or recent sells? No, but if I went to that more information button again from anywhere, from the chain, from here, from the search, I go to company news and information. You can go to the news headlines, and then you'll be able to see institutional buying, I believe, for various Yahoo pages, so it's just one click away to find that information. Okay? All right. Let's go back now there. All right, I just want to remind everyone, those of you that are online, if you haven't done so yet or you haven't taken a trial of Power Options recently, just go to PowerOp.com and put in your name and email address to register for the 14-day free trial. The subscription services after that, we are offering an end-of-day service right now. It gives you access to all the search tools and analysis tools for the given strategies, as well as access to the portfolio tool and the signature tools that we saw, the volatility, skew, and more. The end-of-day data is only $40 per month. The 20-minute delayed service, so every time you run a search, you refresh a page, of course, you're getting the data for about 15 minutes behind, 20 minutes behind. That's $60 per month. And we do offer a real-time service. You can refresh the page at every instant and get the numbers and calculations that very instant. That's $100 per month. And you can add full access to the historical tools, the backtesting tools we saw earlier in the presentation, the chain, the search by symbol, and the search tool, the historical search. The search criteria goes back to April 2006, and the data goes back to April of 2006. But that's $40 add-on to the 20-minute delay to the real-time. So it'd be $100 for 20-minute delay plus historical, and $140 for real-time plus historical as well. All right, scratch this. Okay, let's scratch this for now. Next week, Tuesday at 12 noon, Kurt's going to host his radioactive trading presentation. You can register for that at radioactivetrading.com. You'll see the webinar listed on the right-hand side. Next Wednesday at 12 noon, we're doing a Power Options strategy discussion, and this will be for weekly options. Basic discussion, of course, on what strategies are preferred for using weekly options, how to use the tools to identify positions, strategies with weekly options, and more, and ideas on management. You can register for that right at PowerOp.com. You'll see it as one of the next upcoming live webinars. That'll be Wednesday at 12 noon Eastern. And of course, remember, you can access the archives at any time. Just go to PowerOp.com/webinars.asp, and that will give you access to the full archives there for those things such as the option concepts. We talked about the Greeks and why you may not need them webinar. In addition to that, we talked about some of the strategy webinars of managing bull put spreads, managing naked puts, and more. And then, of course, we'll be back next Friday as well. We'll post that soon. You'll be able to come to our next open discussion, open forum presentation next Friday at 4:30 p.m. Eastern Time. All right. Well, ladies and gentlemen, it looks like the end of our questions. Mike, thank you for joining me, and thank you for bringing me your questions. I really enjoyed them. Sam, thank you as well. Morris, thank you for your question. I hope that answer helped you out a little bit. I want to remind everyone, if you think of any questions later on, please feel free to send us an email at any time to support@poweropt.com. You can also call us during market hours at 302-992-7971. And remember, if you're currently on a trial or a subscriber, you can also schedule one of those coaching sessions at any time. Sam, I apologize. I got caught up with the other questions. I did put your position that you mentioned into the Power Options portfolio, the collar that you mentioned, but I didn't take a look at analyzing it. I'll spend some time on that later this evening, and I'll send you an email tonight or tomorrow with discussion on the SCTY? Solar City, I believe was the symbol, SCTY collar there, to give you some information and insight into that collar as well. Ladies and gentlemen, thank you once again. Have a fantastic weekend. Happy Mother's Day, of course, to all of you mothers that are online with us, and for all of you who aren't mothers, of course, and male, make sure you call your mother or send something to your mother for Mother's Day. Take care, everyone. Have a fantastic weekend. We'll see you next week, either Wednesday for a weekly discussion or Friday for another open discussion presentation. Take care, folks. Good night.